Hey everyone, welcome back to Corporate Decoder. Today we're diving into BioSig's technologies, and let me tell you, it's a bit like watching a roller coaster top. We are talking about their Form 8K, a current report they need to file basically when something important happens. The big news, BioSig Technologies just got a thumbs up from Nasdaq, meaning they've managed to keep their spot on the stock market. It's kind of like passing a pop quiz you completely forgot about. So what happened? Well, BioSig received a notice from Nasdaq's legal team saying they've successfully met all the requirements to stay listed on the Nasdaq capital market. Imagine getting an email saying, congratulations, you didn't fail after sweating over it for months. Back in October of last year, Nasdaq told BioSig they weren't meeting one of the listing rules. This rule is kind of like a minimum grade point average for companies. They needed either $35 million in market value or $2.5 million in stockholders' equity to stay in the game. Think of it as needing to prove you're not broke to stay in the club. BioSig submitted paperwork to Nasdaq earlier this month showing they met the $2.5 million stockholders' equity requirement. It was basically their homework assignment to prove they were financially sound enough to keep trading on the stock market. And it worked. Nasdaq reviewed their submission and gave them the all clear. It's like getting that acceptance letter after waiting anxiously. And now let's step back and look at the bigger picture. BioSig Technologies is a medical tech company. They're in the business of developing a platform for the treatment of cardiac arrhythmia, an irregular heartbeat. It's a potentially life-saving technology, but the path to success in the medical field is rarely smooth. They are not generating revenue yet, so they rely on investors and loans to continue operating. This whole Nasdaq compliance issue highlights a few key things. First, BioSig is operating with very little margin for error. Needing an exception to keep their listing status is not a sign of financial strength. It suggests they're walking a tightrope. Second, their reliance on meeting specific equity requirements shows they're under pressure to maintain appearances for investors. It's like constantly having to show your report card to your parents. Third, while regaining compliance is good news, it doesn't change the fundamental challenges BioSig faces. They still need to get their technology approved, generate revenue, and become profitable. This is just one hurdle cleared in a very long race. Looking ahead, BioSig needs to focus on more than just meeting minimum requirements. They need to prove their technology works, gain market acceptance, and build a sustainable business. Otherwise, they might find themselves back in the same situation next year, sweating over another compliance deadline. BioSig's situation is a reminder that staying afloat in the stock market isn't just about having a good idea. It's about managing your finances, meeting regulatory requirements, and delivering on your promises. This is something the company needs to address, as the report doesn't mention when they plan to generate revenue. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate deep dives. Until next time, stay informed and keep decoding.